Hello, and welcome to episode 4 in our podcast series, Credit Without Constraints, sponsored by our friends at Spinwheel. Today's episode covers a lot of ground, and that's because our guest, Rich Franks, has a deep and wide-ranging set of experiences in the lending industry. He is capable of covering a lot of ground. So that's what we did. Rich is currently a fintech advisor and consultant with prior experience at institutions like Capital One, Credit Karma, and PayPal. And Tomas Campos, who's my co-host for these episodes in this series, he and I really wanted to get Rich's takes on a broad range of different topics, including what consumers want when they're shopping for financial products. This is an area that Rich obsessed over when he was at Credit Karma. How credit products are slowly moving closer and becoming better integrated with the transactions that they're meant to facilitate. BNPL being the best, but not only example that we're seeing in the market right now. The many benefits of consumer permission data, a topic that we've talked a lot about over the course of this entire series, and of course, AI. In fact, we talked a lot about AI in this episode, where Rich has seen it being used by lenders today, why LLMs will be used in credit underwriting, even if it makes risk and compliance folks a little nervous in the short term, and how agentic commerce, when applied to financial product purchases, can be an absolute game changer. Rich also gave a wonderful answer to the question that Tomas has asked at the end of every one of our episodes in this series. If you had a magic wand and could remove one constraint from our credit system, what would it be? Rich's answer is still one that I'm thinking about well after we finished recording, and I can't wait for you to listen to this entire episode. So without further ado, here is episode 4 in our series, Credit Without Constraints. Okay, well, Tomas, lovely to see you for the 4th time. And Rich, thank you so much for coming on.
Super happy to be here.
Well, we are thrilled to have you. You are an ideal guest, actually, for us to end our series on, at least for the moment, because we're going to bounce around a lot of different areas, and we're going to sort of, I think, get to some pretty interesting big picture thoughts about what's happening in the world of credit lending, credit data, AI. Before we get too deep into any of that, though, Rich, I wanted to start by talking a little bit about acquisition. Among your many stops, and you have a fascinating LinkedIn history, my friend, you worked at Credit Karma, where I know you really obsessed over the consumer experience of shopping for and applying for credit. And I was wondering, just for context setting, before we get even deeper into it, if you could describe some of the things that you worked on there, like Lightbox, Easy Apply, and kind of what you observed when you were building those products about consumers' expectations for like personalized credit shopping experiences.
Absolutely. So let's kind of motivate Lightbox with a problem, which is if you think about how you market any product in the world, typically it's all the same thing, which is I need to find out if Alex likes that thing, and then I will serve him an offer if he does, right? And in lending, one of the only products where there's this second question, which is, would Alex get approved for this thing, right? Because lots of people like Amex Platinum cards, but not everybody can get one. Right. And so I think for a long time, these market and affiliate marketplaces would try to guess. They would try to model approvability based on, sometimes bureau data, sometimes whatever data they could get their hands on. And they were okay at it. And so Lightbox, the concept was, hey, why guess? Why not just take an environment, give it to a bank and say, hey, come in here, code up your credit policy. And then anytime someone logs in and looks at offers, we will check whether you would approve that person. And then we can decide whether or not to make the offer, decide how to frame the offer based on whether you think you would approve them. And so that was the entire premise of Lightbox. Over 5 years, like 2019, it was this crazy idea that, we weren't really sure if it would work. 2024, Experience building their version of it, Moneyline's building their version of it, like pretty exciting to watch. But you asked about insights. Like here's the really interesting thing, which is, kind of obvious in retrospect, is that consumers are not used to knowing whether they will get approved for something. Average approval rates in credit cards, data that's a couple years old now. I think I saw like 38% of people will get approved, right? So you can tell them like, hey, your chance is 80, 90% of getting approved for this. Like that changes their behavior. If you can tell them instead of APRs between X and Y and loan amounts between A and B, this is your loan amount, this is your APR, this is your initial credit line, people react really well to that, right?
Yeah.
In fact, even stuff like, this is fast funding. You're likely to get the money today or tomorrow. People react well to that. So I think the big thing on Lightbox was just like, wow, people really want certainty in what's going to happen to them.
That's fascinating. And maybe just to make one additional point on that, and I'd love your response to this, but it kind of goes back to what you're saying about like the difference between credit products and every other product that someone buys over the course of their life. Like maybe the example is like Amazon, right? I think Amazon made a tremendous progress in advancing our sort of shared understanding of e-commerce, partially because of discoverability and finding products. But I think a big one was certainty around shipping. Like this will be to you at this point, right? And for most things, like, it's a convenience. It's nice to get it quick. But like if I'm planning a trip and the trip is 3 days away and you can guarantee 2 days shipping so that I'll get this thing that I need for my trip before I leave, I have certainty and can plan around that. And that is a value you are bringing to me. And I think what we're saying is that in financial services, you're getting a loan for the purposes of something, right? Like I always like to remind people, like you're not getting a loan just because it's fun. You're getting a loan for a thing. And that thing has constraints, right? Like I need this, but it needs to have this interest rate, or I need to get the funding by X or Y or Z. And the distinction between it and almost any other product is that certainty doesn't exist. And so it makes planning just ridiculously hard for customers. So it sounds like when you guys launched this, that was the reaction you got from consumers.
That's exactly right. And I'm so glad you used that Amazon analogy because that was a lot of the analogy that I was using in the early days of Lightbox was Amazon Prime. Mm-hmm. You talked about one piece, which was the certainty. The second piece was the friction, right? I love the buy now button in Amazon, and it's 2 clicks, right? It's 1 click to say, I want this, 1 click to say, yep, here's, shipping's right, payments right, all that kind of stuff. Boom, 2 clicks and I got the thing. And that was the inspiration for, you asked about Easy Apply. That was the second product that we spent a lot of time on over those 5 years, which was saying, hey, can we get a credit application down to 2 clicks? And I'll tell you a funny story. I used to always say, can we make it as easy as buying paper towels with the buy now experience? And so I would, screenshot paper towels for the buy now experience. And a couple times I accidentally ordered paper towels. So like there was a period of time where I had like a ton of paper towels in my house because of this analogy.
That's so funny. That is so funny. I love that.
Can we maybe break that down a little bit, Rich? Because I'm glad you brought up the friction point, because I think there's if you have the certainty, but you still have the friction, you probably still have a lot of drop off and the consumer doesn't get what they're really looking for. So I always think about this as, there's sometimes these barriers that exist between these lead aggregators or where the consumer starts their journey and then the financial institution where they're actually getting the product from. Can you break that down a little bit in terms of what you saw and the typical problems there?
Yeah. I mean, you think about the bad version of this. It is the consumer goes to the lead aggregator. They pick out the product they want. They click the apply link. And then what happens? Like if they're lucky, they get a totally different experience, different fonts, different branding, different colors, whatever, iframed into the place where they were. And it's like, okay, that's a little weird. But, at least they're, it's a little bit of consistency. The less good version is they get a message that says, you are leaving our safe walled garden. Good luck out in the wild, right? And then they get to the new site, and the new site's like, all right, tell me who you are and why are you here and what do you want? And can we pull your credit? And the consumer is like, are you kidding me? I literally just did this 5 minutes ago, right? Because they don't care about legal entities and API endpoints and stuff like that. Like they're like, I want a product. I clicked on the product, and now I'm somehow doing the same thing twice. And so I think that there's been progress. Like there's some pre-fill experiences that have made this a little bit better, where when the consumer gets to the lender, their data is pre-filled on the lender side. I think Easy Apply mostly solved this in credit cards, although I didn't, I didn't quite stay long enough to finish the journey in PL. I still think there's a lot of work to do there. So I think the North Star, the thing we should all be building towards is, can you have not only one experience, right? It's not 2 companies. It's not 2 websites. It's one thing, where almost all of the work to be done is done by data calls in the background, right? KYC, credit, fraud, income, whatever we need. Let's do data calls in the background, even if it's more expensive, get those things done quietly without consumer interaction. And then just, hey, you wanted the loan, you get the loan, just like the paper towel. So, Tomas, like you guys have at Spinwheel, I know you guys have like tokenization that kind of allows this, right? Maybe why don't we build this together?
It's interesting. So we took a lot of inspiration for what you were building and what you guys did at Easy Apply. One of the things we saw was, how do you take Easy Apply to its ultimate goal to ultimately fulfill that promise? And one of the things that we saw that was one of the barriers there, Rich, was because they're behind the scenes are two entities, you end up having to have two users. Ultimately, you have a user at the lead aggregator and then a user at the financial institution. And being able to create that one single and seamless user such that, like, I don't have to put any information again. You can do all the data calls. You know where the data calls are going. You can drive that experience the way you just described. That's fundamentally what we're trying to do. And a big part of it is because we said, hey, Easy Apply is the way that this whole industry should work. The challenge is not everybody takes advantage of it. Sometimes you have to code to it. Everybody still has their own uniquenesses in the funnels they want to drive. And let's be honest, I think a lot of lenders want to maintain that innovation and creativity in their funnels because they see that's sort of something that they can innovate on. But how do you do that if you're trying to make everything sort of vanilla? Well, there's that tension there that you're trying to solve. But if you do it in the way you just said, which is, hey, let's do this with, let's say, a tokenized user, all the data calls, you can still have a lot of innovation on the funnel, but you eliminate all that friction and you eliminate all that sort of, hey, I ended up at a blank page, or I had this jarring experience where I got, dropped off somewhere that I didn't expect. So we really kind of took a page out of your book and try to follow your lead there.
I love it. And by the way, the fact that you guys did it outside of the context of one existing market and affiliate also means that it can become the public utility. It can become the way things work instead of being, yeah. And I think that's the problem right now, is that there's so much innovation happening, but so much of it is branded innovation in the context of one marketplace, right? And you think about what you're doing, like, yes, this could be applied generically anywhere. And I think that's where we need to be going.
No, that's absolutely the goal.
Yeah, it's fascinating too, because the idea of like solving friction problems while leaving space for competition and differentiation, I think is a really hard balance to strike too. And so it is fascinating. The other thing, Rich, I wanted to ask you about that's related to what we've been talking about, kind of this collapsing of like the friction and the distance we put between what the customer's trying to do and sort of what we force them to do, is the space between like lending decisions and the transactions that they're for. So again, this notion of I'm getting a lending product for a specific purpose. One of the things that's fascinating to me is that historically, and I think this was mostly a function of like technology and the cost of underwriting and availability of data and all of these things, we kept those two ideas very loosely affiliated and very separate in a lot of cases from each other, right? So it's like, hey, I want to do this. Great. I will underwrite you for a credit line that will allow you to do that, but in like a very loose, disconnected way. Whereas, the customer is actually saying, I want money for this purpose. And I would imagine that from a convenience perspective, from a customer experience perspective, from a risk perspective, underwriting what the customer wants to do and having a product structure that ties the customer's intended transaction to the product you're underwriting has all kinds of benefits. And I know you think a lot about this. So like, what's your take on that evolution? Because I'm seeing a lot of interesting stuff in the market around that.
Yeah, I love this this concept right now. And I think this is like, we're entering like the second phase of fintech in a way right now. And I'll explain what I mean by that in a minute. But, I think that the first phase was this realization that, hey, little small private companies can go get access to private credit and build beautiful customer experiences and really exotic underwriting strategies and use all this cool alternative data, move faster than the incumbents, et cetera, and create great businesses. And so a lot of people did that. And they ended up with really great lending products. But like, what was the purpose of those lending products? I don't know. I don't think they knew. I don't, right? It was like, customer, you figure this out, right? You want to take a vacation, redo your bathroom, consolidate your debt, have a wedding. I don't know. Good luck. Do one of those things.
Right. Navigate our products for your purpose is kind of what we were asking people to do, right?
Exactly. And I think like the place where maybe it worked okay is debt consolidation, because I think that was a pretty clear use case. But even still, you look at what happened there is people would consolidate debt. You'd see their utilization go down dramatically. And then 18 months later, you'd see it back to where it was, or even higher than where it was before they consolidated the debt. So like, I don't even know if they got the value.
FICO had to adjust their scoring model to account for that weird bump that people were getting on their FICO scores that wasn't representative of them changing their behavior. They were just paying down their credit card debt. Yeah.
Yes, exactly. And so now, I think like Okay, great. We push that thing as far as we can. Now the question is, how do you eliminate the concept that there's two activities, right? There's like some commerce activity occurring that the consumer is engaging in, and then there is a lending activity the consumer is engaging in, right? How do you make this one thing? And I think people talk about embedded lending, like BNPL is the ultimate embedded lending, right? You buy, it's not like you borrow money and then buy Nikes with it. You buy the Nikes and you pay back in 8 installments or 4 installments over 8 weeks. Point of sale. You don't like take a loan and then buy your kid braces. You pay back the braces in 18 equal installments over 18 months. And then I think, like even in debt consolidation, we're kind of entering phase 2 of this where, before there was this really clunky process where you could do lender initiated payoffs of existing debt, but it was nasty, that the data was latent, et cetera. Now I know Spinwheel has pretty cool tech for doing this, right? Where now it's like super consumer friendly. It's real-time data. It's like minutes of work, instead of this painful slog. So I think this is where the world's going. I think the days of like, let me go choose an option in a marketplace and then figure out what to do with the money, like those are going to be gone soon.
Can I double click on that for a second, Rich? Because the way you frame this triggered a thought, and the thought is, we work with a lot of lenders today, and a conversation from last week was we're working on their APIs on how the data is coming into their system, and they have a field, and the field has to be provided, and that field is what's the stated purpose of the loan, right? And so almost like exactly what you said, the consumer has to specifically say, this is why I need the loan. But in that same conversation, we were talking to another member of their team, and they said, well, when we know it's coming from, let's say, a home improvement aggregator, we already know what that stated purpose is. We don't have to ask the consumer. And I go, why isn't that the case for everything? Like if you have the context and you're there when the consumer is trying to engage on the topic that they need, you don't have to ask them anymore because that's what they're trying to do.
Yes.
I'd love to get your thoughts, because BNPL seems like the perfect example. It's like, I'm checking out. This is what I need it for.
Totally.
Whereas for a lot of other personal loans today, or even HELOCs, it's like, well, what do you need this for? Why do we already know that? Like, we have enough of this information. It feels like that's something we should already be able to provide that context for.
Right. Like, and by the way, like, I think that the funny thing too is like those drop down boxes for loan purpose have like 5 options, right?
Yeah.
And so it's like there are only 5 things you could possibly do. Like, what if I want to go, I don't know, research quantum computing with this money? Like that's
sure.
in the box.
Large
right?
purchase. That's typically a large purchase.
That's fair point. Yeah, that's right. But no, I think you're right. I think that like the holy grail in anything is getting to the point where the communication stops being necessary. Like I think about this a lot, like, a small example of this is the loan purpose that you just talked about, where it's like, hey, the context is so obvious that the loan purpose is now inherently clear, right? I think in consumer lending product design, like we've got to start thinking this way as well, where it's like, hey, why do you need a Schumer box? Why do you need a TILA? Because these loans are so complicated that it takes 30 pages to explain them. Why? Right? Maybe like rather than solving this with transparency or drop down boxes or whatever, like let's solve this by making the thing more obvious and more simple. And so great example of that, Tomas.
Yeah. And something we're trying to drive, because I think we know most of this context, or at least we can make it so obvious that you don't have to have that explicit sort of drop down box anymore.
Totally.
Can we talk about, if we're talking about this context and how you get this context, it feels like you need more of this sort of consumer permission data to help you provide that context, so you can take that burden off the consumer. And I know in our previous conversations, you're a big advocate for consumer permission data. Consumer permission data has been around for a while, right? It's not like this is a new concept in 2025 or 2026. So it's been here for a while. How do you think about consumer permission data broadly? And then 2, the real-time capabilities of consumer permission data, and what maybe potentially the impact that like real-time data might have in this overall context.
Yeah, totally. Well, okay. So let's go back in time to like March 2020, early days of COVID. I was, it was my early days building Lightbox at Credit Karma, and all of a sudden the world starts falling apart, and every lender's pulling out of the market, and lenders are pulling off of my product, and I'm calling them and saying like, what can I do? What can I build you, give you, get you, whatever, to get you to stay in the market? And everyone said the exact same thing, which is, right now, all the data that I use for underwriting tells me what happened with the consumer's debt obligations a month or two ago. And what I really need to know today, because the world is changing so quickly, is did this person pay their rent 2 days ago? Did they get a paycheck last Friday? Right? Like these are the actual questions. And you can't get that anywhere. And so I think consumer permission data solves both of the problems that are implicit in what I heard from all those lenders. One is the inherent latency in the data, right? If I'm using something, and by the way, let's be honest, like bureau data is incredible. It is like actually amazing. I worked in Australia for a little while, got to see what the world looks like without positive credit bureau data. It is it's a lot different and a lot worse. Now they have it, by the way, but back then they didn't. And so it solves this issue, which is that like inherent in the way that credit bureau data works is that it is latent. Inherent in the way that credit bureau data works is that it is one side of the balance sheet. And so I think allowing consumers to say, I'm going to permission the other side of the balance sheet. I'm going to permission data that is real time as of today. I'm going to permission data that, will help let you get a fuller picture of who I am and what's going on with me. Like that is to everyone's benefit. And I think like the place where we've been talking about this the most has been cash flow underwriting. And we've been talking about it for 10 years, probably. And it does seem like finally the last year or so is where I'm starting to see real progress on consumer permission data, not just in the cash flow underwriting context where, companies like Prism and Nova are crushing it right now, but also like what you guys at Spinwheel are doing on the liability side of the consumer's balance sheet as well. Like it's just like the world is finally ready for these things. And I think because of that, it's like, wow, we found product market fit, but we're still just getting started.
Yeah, it feels like that.
Absolutely. All right. This has all been the appetizer for the main course, which is AI, and something, Rich, we wanted to spend some time on with you because, well, we've talked about AI in all the episodes of this series. And I think I may talk about it in every podcast I record this year, it feels like. There are some really specific things that are happening in lending. So, Tomas, I'm going to steal your first question on this AI topic because I just want to jump right to us. Yep. Rich, given your work across a large number of different lenders and lending infrastructure companies, I think you have a particularly wide-ranging perspective. Where are we with AI in the industry right now? Where are LLMs actually being utilized?
Yeah, so I think the answer is that everybody's kind of nervously playing, but the use cases are evolving in lending a little bit more slowly than I'd like them to. And I think it's just a little bit of the nature of us being in a regulated industry. But if you look at consumer facing use cases, I think like chatbots are the main thing, sadly. And I say sadly, not because chatbots are disappointing. I actually think that if you look at the way that, the three of us interact with AI chatbots to do our jobs every day. I mean, I'm assuming you guys do too. Like they are incredible. What's disappointing is that in many cases within like lending use cases, they're dumbed down by legal and compliance teams who are very rightfully afraid of hallucinations. And so you end up with chatbots that really aren't a whole lot better than like the NLP chatbots that existed 10 years ago, which I think is really a missed opportunity. Hopefully we solve it at some point. But I think then like there's this, so that's category one. Category two is the stuff that is making, it probably filling up my LinkedIn feed and all of my Bay Area dinner conversations, which is software engineer and product manager productivity, right? You look at SWEs who can now be as productive as, 5 or 10 of their colleagues a year ago because they're able to code with AI. You look at PMs who don't need to go find a designer to create 20 different Figma flows. Like they can just create code-based UIs that, work 2 minutes later. I think that's crazy. I would not want to be an investor in Figma right now. So I think this is really cool, but getting lots of attention. Let me talk about, I'm just going to share 3 examples of places where I have implemented AI in the last year.
Yeah.
That have been like kind of unique lending use cases. So one is in big banks, the legal and compliance process is like one of the hardest parts of doing new credit policies, new credit models, stuff like that, right? And I've implemented AI agents that can take what in many big banks is literally a multi-month, many month process and run it in minutes, which is the process of doing things like assessing, 5 or 10,000 variables that might go into the policy for legality, generating adverse action reasons and logic, doing fair lending testing, disparate impact testing, all that kind of stuff. So it takes this like multi-month, you got to have a bunch of specialized skills, and makes it minutes of work. And then you have a lawyer review it afterwards and say, do I trust this output? Second example is implementing a co-pilot for data scientists that are building credit policies and credit models. So essentially, the data scientist can go into the environment and say, build me an underwriting model for our U.S. personal loans portfolio. And by the way, exclude the 2022 vintage because I don't think it reflects our current product suite. And then like, boom, model shows up. And then the data scientist looks at the work and says, yeah, based on this, like, I'm not really sold on variable ABC. Can you replace that with variable XYZ and rerun the model and see what happens? And so this, this type of stuff cuts timelines. Like what we saw was it cut timelines in half. I think actually it could go further as data scientists got more and more comfortable with the quality of these tools. And the third thing, the hardest thing that I've done was building a net present value model, an NPV model with AI, which is something that, this can be 100 hours of work for a decent model. And we did it in, handful of repetitions with Claude. It was weirdly harder than these first two things that I mentioned to get AI to think that way. But we quickly got to something that I could have put in front of any chief risk officer in any major bank, and they would have said, yeah, this is reasonable.
Wow.
That's pretty cool. What if you think about the attribute or the quality of an LLM today that makes lenders the most nervous? Like, what is it? And what would be the thing that makes them use it a lot more?
Yeah. So the number one thing right now is explainability. That is what everyone is talking about. And it's lenders are terrified of having to stand in front of a regulator and say, I don't know why Tomas got declined, but this thing is really powerful. Right? Yeah. They need to be able to replicate the decision. Like, a year later, regulator comes in and says, explain to me how you made this lending decision. If they can't replicate that math, they're in trouble, right? If they can't produce an adverse action notice, they're in trouble. So I think that's the thing that's holding us back. But here's the thing. My opinion is that we've been through all of this before. So I don't know, 10-ish years ago, when gradient boosted models, machine learning models became the thing we talked about in underwriting, literally people made all of the same arguments, right? It's like people were accustomed to the fact that logistic regression gives you an algebraic looking equation with this transformation that happens at the end of it. And that gave them comfort that they were understanding what the model was doing. And then all of a sudden with gradient boosting, it's like, well, you have these incredibly deep recursive trees and I don't really understand. I can't put this into simple math. And people freaked out and they said all these things like, this will never work because. And then we sat down and we said, well, wait a minute, like what's, how can you get adverse action reasons? Let's look at SHAP values. And how can you look at individual variable effects? Let's look at marginal effects plots and all these things. And once we kind of said, like, it doesn't need to be a math equation, it just needs to be explainable, then we got okay with it. Now, when it comes to LLMs, I think there's this one additional thing that will make it harder, which is determinism, right? Which is at least with a machine learning model, if you run it 5 times, you'll get the same answer. Right? With an LLM, that is not true. And I think that really scares people. But I've seen like, and I'll be honest, like this is not something that I've done a lot of research on, but for example, like CAN models, Kolmogorov, Arnold networks, stuff like that, like theoretically could be collapsed into symbolic equations. And so you can say like, okay, there's a way I can represent this thing as a formula. So I don't know, maybe. But I think that the bottom line is like, we will get through this just like we got through the machine learning thing 10 years ago. And there is no world where we're not using AI and underwriting like 5 or 10 years from now.
Yeah.
Yeah, that makes sense. That makes sense to me. I mean, to maybe add to that, and Tomas, I'd be curious for your opinion on this too, because you talked to a lot of lenders about this same question. I mean, it seems like, I think I agree, Rich, like this explainability point is such an interesting one because it's sort of like, well, what type of explainability are we talking about, right? Like, do we know deterministically exactly how this worked? Maybe not. Explainability used to be, before we used computers to make lending decisions at all. Remember, like these lending laws came from the 1970s. It used to be like, hey, ask the human being why they did this. Well, sometimes humans don't know why they do things or why they made certain decisions. So like,
that's right.
Explainability as a form factor evolves. And I would actually argue that you said adverse action notices. Adverse action notices suck, man. They are terrible today.
Totally.
And they're terrible because they are mostly a check the box exercise based on some like rules and traditions that have been established in lending for years that are sort of unofficially, but not totally officially, but somewhat officially blessed by regulators as like, that's good enough. And you don't want to give, a fraudster too much insight into your underwriting process. And so you're not going to like reveal all the like twists and turns that your model takes. But the net result is that a customer who's frustrated about not getting approved, going back to your earlier point, Rich, about 38%, like what the hell, they get a notice that says it like insufficient credit data. And you're like, I don't know what that means. Like that doesn't
Right.
mean anything to me. And so it is interesting to sort of like note that maybe the answer to this is, yeah, the math might be a little harder to explain or even to replicate perfectly every time. But on the flip side, every single person gets an LLM generated personalized explanation of their entire credit history, how it led to this moment, why it didn't quite work out this time, but what they could do in the future. Like, did we just improve explainability for consumers at a large level, even though we sort of changed the mechanisms? I mean, I don't know. I wish the explainability conversation was broader and more creative, I guess is my point.
I was just going to add, it feels like the explainability, the concerns around explainability are more related to how I can explain this to a regulator than maybe I can explain it to a consumer. To your point, Alex, it's like, feels like that's a great way to help the consumer understand it better versus this obscure adverse action that gives me no information.
Yeah. That's the thing that it makes me laugh. Like, you mentioned insufficient credit data. At least I kind of know what that means. Like, what if the adverse action letter says number of bank card trade lines, right?
Totally.
It's like, well, is the number too small or too big? And like, is my charge card a bank card? Is my retail card a bank card? It's crazy. But I think you're right. Like the customer, who's the customer for Attila? Who's the customer for adverse action? Who's the customer for a Schumer box? It is not the consumer, because if it was, these things would be a lot simpler and a lot more thoughtful. And yeah, you're right. Like LLMs are perfect at this stuff.
They're great at it. Yeah, I mean, imagine having an adverse action notice that's interactive that you can query. Imagine having an adverse action notice that can sit on your shoulder for the next 10 products that you apply for and give you advice and like analyze. Like, I mean, this is a little science fiction-y, but like, what if your adverse action notice becomes your personalized PFM tool for making financial decisions differently for the next 5 years, so that the next time you apply for this product, you're in a better position to do that? Like, why don't we think about adverse action notices that way? And so totally. I think that, again, this need for creativity and not getting hung up on, and I love your framing about it, Rich, like, who are all of these notices and things for? They're for regulators. They're to check a box. Like we're leaving the customer, who ostensibly is the reason we're doing this for, sort of out of the equation entirely. On this note, relative to this, I wanted to ask you about agentic commerce, because agentic commerce is like, I mean, you're in SF. I feel like every conversation I have with people is like, aren't you so excited about agentic commerce? And to a degree I am, but I also will say, like, I find sometimes with these sort of very hot technology areas, the people building it get way more excited before there's any like clear demand from customers, where it's like, we're going to build this. And it's like, great. Does this actually solve any problems? And it's funny because I haven't really seen too much conversation around the notion of agentic commerce applied to commerce shopping for financial products. But as we were just talking about earlier, and given your background, like agentic commerce feels like it might be very powerful in a financial product context. What are your thoughts on that?
Yeah. Okay. So I'll tell you, by the way, you mentioned this, like the developers get more excited than the people, the end user sometimes. And I think that's generally a thing. I'll tell you, anyone who has worked with me knows I'm kind of a grouch on new ideas. I'm like, I don't believe it until it's proven itself. I'm a skeptical person. And I would say, I truly believe, like maybe for the first time in my career, I truly believe like this is like a transformational, this time is different and different forever type of moment. And like a small example of that is like, when's the last time that either of you Googled anything? Like for me, it's been a year, and it was not a slow switch. It was like one day I stopped Googling stuff and then I just never Googled again,
Well, it honestly reminds me, just as a side note on that, we're all old. Ask Jeeves was great. And it wasn't because the search engine behind Ask Jeeves was great. It sucked. That's why it lost.
Yeah.
But the framing of ask a question, like it's so weird that we spent a decade plus retraining our brains to think in keyword searches. Keyword searches suck. That's not how the human brain works. Like we ask questions and want answers. So anyway, Rich, to your point, like I love asking questions and getting answers.
Totally. Well, I'll tell you guys a crazy story. So I was, in my Bay Area bubble at a dinner recently, and I just asked like everyone pull up whatever AI agent you use every day, and ask it what is your primary credit card. Like it doesn't know the answer, right? Just ask it like based on what you know about me, what do you think is my primary credit card? And every single person at the table, it predicted their primary credit card perfectly, which is insane.
Wow.
Right? And you think about this, like you think about cards like, let's say Chase Sapphire Reserve versus Amex Platinum, where you could argue like they're very competitive products. Right? It even got those distinctions and could say like, you could be a platinum person, but I think you're a CSR person because of this or vice versa. And it was right, which is crazy. So, okay. So I think, if you are like marketplaces, like, whatever, any of the affiliate marketplaces are essentially financial stores, right? Like we've got a large inventory. You come in, you look at the inventory, you decide what you want to buy, and you go buy it. And they've made a ton of effort to improve the ranking and quality of the inventory. And a lot of that was based on really cool deterministic concepts, but like Lightbox, right? Like it's actually, you feed all the data into a model and you get a yes or no. I think in a world where my AI agent knows which credit card I use, I actually think that you could probably beat Lightbox probabilistically with AI, right? And it wouldn't be your chance of approval for this product is 87%. It will be like, this is the right product for your life. And let me tell you all the reasons why, right? And I think in that world, if I were in a marketing affiliate company, like I would be like, oh my gosh, I have to be thinking differently really, really fast right now. By the way, some stats, like I have a couple of stats here on this, like 82% of Gen Z and millennials are already using Gen AI for financial planning. 85% of consumers who receive a financial recommendation from an AI agent act on that recommendation, which is crazy. I don't know, like there's no one in my life who's ever listened to me with 85% fidelity. like
my
that's
kids
crazy,
certainly
right?
don't. I can tell you that much. Yeah.
And then the last thing here is like finance is the number two most common use case for Gen AI right now. The only thing that beats it is health and wellness. So, it's like the number two most common use case. More than 80% of people are engaging and asking questions about it. And then more than 80% of those people are following the advice they got from it. I think like this world is, and by the way, it's really good at giving answers. Like this is a totally new industry.
Two questions on that, Rich. So for me, it's pretty easy to see how what you just said completely disrupts the traditional marketplaces and funnels. Like, as you said, because like the AI agent should know all this about me already, and it can do all these things that I had to go and fill out, like with me just asking one question. Do you think that companies that have sort of built their models around organic search and content, do you think they make it? Or do you think that they really have to sort of say, okay, that's gone. I really got to dive into this sort of this whole new paradigm of how funnels and leads work?
Yeah. Well, let's say like they either have to do one of two things. They either have to move, or they either have to start thinking like AI first, and not AI first is like, let me build a cool chatbot, but AI first is like, let me integrate with Gemini. Or they have to start thinking down funnel and saying like, I am not going to be the answer for discovery anymore. So I need to start thinking down funnel from discovery and create value there. That's what I would be doing. I mean, or they have to like go figure out go get
do new
jobs. I don't
know. But then, so that's perfect. So the next part of that question is, how bullish are you or not on these agents not just being used for discovery, but actually like doing all the stuff for you, like taking all the actions, and it's as simple as me just saying, yeah, you did the work and I approve. Like, yes, I still have to sign the truth and lending agreement. I still like, yes, I'll do that, but I expect this agent to have done everything else. And it's as simple as me just going, yep, I approve. Agent, you did a good job.
Yeah.
Make it happen.
So I think really your question is like thinking about autonomous finance, like how far do we go with autonomous finance, right? And I think the answer is the open claw version of autonomous finance, like open claw, deletes your entire inbox, or moves your 401k into Bitcoin or whatever. Like, I don't think we get there, but I think we get to a place, to your point, where the agent can say, "I've queued up everything you need to know, but I need your permission to move forward." And I think that would be really cool. And I think that you look at the tech needed to make that happen, it's not ridiculous, right? Like I have these apps on my phone. They know my phone number. I know that with Spinwheel, my phone number could turn into my entire PII very easily, my credit data, everything, right? Like the work to do this is not hard. I think, I don't know. I think we got to go partner with one of these those companies and make this happen.
I'm on it.
If anyone is listening, this is a perfect opportunity to reach out. Tomas, I will give you the honor of the last question, the question we always ask our guests. I'm very excited to hear Rich's answer to it.
All right. So Rich, the whole name of the series is called Credit Without Constraints, right? And so if you had a magic wand and you could eliminate any one constraint that you see today that's holding back consumers and how they access or shop for financial products, what would that be? What would you get rid of with your magic wand?
Okay, so I have to say this very carefully because I don't want people to misinterpret this. I think it would be the artificial constraints imposed by the regulators and laws, or people's perceptions of regulators and laws. Which is to say, I believe a regulated financial industry is better for consumers, but I believe that adverse action notices, as we've implemented them today, are not, as we talked about, right?
Yes.
And so I think that we've got to find a way to be able to go back to first principles with regulators and lawmakers and say, the goal is not to tell us how. The goal is to let's let the industry figure out how, subject to some bounds, and let's focus on like the what and the why together. And let's actually partner on that. And I think there's so much fear. I think, like if you're a politician, you don't want to be seen as like, too nice to our industry. If you're a bank, you don't want to share too much with their regulator and get in trouble for that. Like we've got to eliminate all this fear and of each other. And we've got to be able to sit down and say, like, let's just focus on first principles. What does the consumer need? How do we deliver that simply and elegantly?
That makes a lot of sense to me.
Yeah, I love that. It's a good call to action because, as you were saying, Rich, this time does feel different with the capabilities, right? And you live in the bubble, so you have a better view of it than I think I do. But it's just a moment where it feels like we can really reset a lot of the sort of assumptions that have kind of calcified a bit in our industry. To your point about like, is it the regulation? Is it the assumptions we've wrapped around the regulation? It's something. And like, this is a cool moment to be able to step back and do that. Perfect place to leave it. Rich, thank you so much for hopping on, doing little prep, as you said, before we started recording. This was great. This is exactly what I think we were hoping for.
Thanks, Rich. I appreciate it.
Awesome. So much fun with you guys. So good to hang out with both of you.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.